Welcome back to Cheddar Business, everyone. Stocks are at record highs as China is cutting back on American import tariffs by 50%, affecting $75 billion worth of U.S. goods. The move comes amid ongoing trade tensions and the deadly coronavirus outbreak, which some have warned could damage the Chinese economy. Joining us now is Joe Brusuelas, chief economist at RSM. Joe, it's good to have you with us. Obviously, this is enough to send the markets to new highs, huh?
Right. No, this is actually a fairly good development given the quick shifting price mechanism inside agriculture. I think the Chinese gave the United States an olive branch this morning and said, hey, we're following through our end of the bargain, and we'd like a little bit of flexibility around the purchase targets of agriculture this year. The sharp decline in soy prices this year, especially the volatility we've seen over the last several days, strongly implies the Chinese won't be able to meet those targets.
Now, does any of that have to do with the coronavirus, right? And the lack of economic activity we've seen in China, with some estimating that 4 percentage points could be cut off GDP there because of the outbreak?
The last several days, without a doubt, that's completely true, but the downward trend in overall demand was still there. So I think that you should expect to see a significantly slower pace of growth in China in the first quarter. At first cut, I had 1.6% coming off it, but as we see, close to 800 million people are effectively under quarantine or self-quarantining, their economy is going to grind to a halt.
So why aren't U.S. markets more affected then, Joe? We saw last week a major sell-off toward the end of the week over fears of the spread of the coronavirus and the surrounding implications. But this week, record day after record day.
Well, let's be blunt about this. The markets have priced in the reopening of the Chinese economy based on a February 10 target that's been strongly influenced by Apple's decision to reopen their stores April 9th in China, maybe February 9th, February 10th here.
This is close. This is just a few days away.
Well, that's why this isn't over. We really want to be cautious around this because, Cowen put out a note the other day saying that we hit peak coronavirus. And I thought, okay, that's not true. And sure enough, what are we hearing from the World Health Organization, CDC? It's not true. So if the cases really begin to soar, market will reassess pricing levels on equities. But for now, look, absent coronavirus, that market wants to go up.
That's right. But it does appear, we have not heard from the U.S. that it's going to hold up its end of the bargain, right, and actually cut its tariff rate on these Chinese goods as part of this phase one trade deal, even if China does do it.
So I'm an economist. I'm a card-carrying free trader. This is the problem with managed trade. And it's the irony of this is the Trump administration started this to get the Chinese to stop doing managed trade. What did they do? They signed on an agreement where we're all doing managed trade right now. So that's always going to be an uncertainty going forward as long as, the two parties are engaged in the tit-for-tat struggle for supremacy. I would like to see us go back to free trade. That would be better for all. But for right now, we're just going to have to live with that uncertainty.
How long is that uncertainty going to persist?
Indefinitely.
Really?
Yeah.
Just specifically is this something that would change if President Trump were not in office? Or is the next president going to inherit?
Well, if there's a President Bloomberg, it might, but the other Democratic candidates, no. There's a bipartisan consensus in Washington that China has to be confronted for a whole range of reasons that just don't have to do with trade or economics, and we can leave that to generals and majors to talk about.
But why do you keep Bloomberg out of it? Because we haven't heard a clear stance from him yet?
I know Mike pretty well. I was the chief economist at Bloomberg for many years. Bloomberg's a markets guy, a free trade guy. I would expect that Mr. Bloomberg, if he were elected, would probably prefer the multilateral lane, meaning we're probably going to end up in the Trans-Pacific Partnership, where we contain and constrain China with 40% of global GDP, as opposed to just a dyad of conflict between Washington and Beijing. I think that's the way to go.
Look, I know you're here to talk about the economy, but because you had this role with Bloomberg, do you think that he has a chance to get to make it to November as the nominee?
Anybody who's worked on Wall Street over the past 3 decades will tell you never underestimate Mike Bloomberg, ever. And let me tell you what, if Bloomberg's terminal was running that Iowa caucus, it wouldn't have happened.
Sure. Well, maybe there's a reason, obviously, why he didn't even hardly campaign at all in Iowa. Right, on the ground. He used it as an opportunity for himself. But I would say that the sentiment on Wall Street does seem to be complacency with Trump, even when you ask about Bloomberg, right? They say, well, The market's at record highs. Why not just keep it going like this?
Well, there's more to life, more to the economy, more to finance than record highs in the Dow and the S&P. I personally think this breaks right. Market won't respond badly to Mr. Bloomberg rising in the polls. As a matter of fact, I think it might boost it.
Well, let's talk jobs because we are expecting January's jobs report to hit the wire at 8:30 tomorrow. We got some positive economic data throughout this week. What are expectations going into tomorrow?
All right, so I'm expecting a gain of 155,000 on the top line. The unemployment rate remains steady at 3.5%, a 0.3% year-over-year gain monthly gain in average hourly earnings, which will translate to around 2.9% year-over-year. But, and this is the big but, we're going to get our benchmark revision for the data between April 2018 and March 2019. You should expect 500,000 jobs to be lobbed off the total employment.
Why is that?
Well, typically late in the business cycle, first, second, and third estimates of monthly employment tend to overestimate the strength of the economy. This isn't anything that's unusual. It's going to be the biggest since 2009, but even in 2012, we had a net reduction of 412,000 one year following a benchmark revision. I think the big narrative out of this, though, we've got really weak wage growth, even somewhat wage stagnation. We're just stuck below 3%. Once you begin to lop off those jobs, you begin to get a better explanation of what's going on in terms of
why aren't we seeing wage growth? Unemployment is low. Macroeconomic theory says when unemployment is low, companies have to pay their employees more to attract and retain them, but we're not seeing that manifest in the data.
Well, macroeconomic theory also says you need to see higher rates of productivity than what we're getting now. The 5-year average is 1.19. We're at 1.7 on the quarter. And we've also got very low inflation. When you get that sort of macroeconomic mix, the result is low wage gains. They're just not there. And where you're seeing the wage gains are often tied to increases in minimum wage or the move towards the livable wage of $15 an hour in the 25 major metros.
Why is productivity lagging?
That's the biggest puzzle in macroeconomics. I would think that given what we see in technology, that we'd be having a boost in productivity. I think the first question is, are we measuring it right? Given the rise of the digital economy. My sense is we're probably not. When I go out to Google or we talk to Amazon and you go out west, they just quietly laugh and say, we're not measuring this right, we just haven't quite figured out how to get there yet. The other argument is essentially this: all the low-hanging fruit's been picked. We're not getting these big productivity boosts out of sort of the free economy that's risen on the internet. So we have a lot more to learn, a lot more to investigate, and perhaps in a few years, as artificial intelligence and machine learning become a more pronounced part of the economy, we'll see productivity take off.
Joe Brusuelas, we got to leave it there. Thanks so much for joining us on Opening Bell today. Joe's chief economist at RSM US.